many folks, there's a lot of cross-cutting different pieces of information that are out there in terms of what's going on. And so while often it makes sense to get down into the nuts and bolts of all the individual pieces to really build that rich understanding and perspective about what's going on, I think in this sort of circumstance, it's also important to sort of take a step back and start to think about what are sort of the key aggregate ways of looking at what's going on in the economy. And the reason why that is because when you have an environment of a lot of cross-cutting things, you can pick information that points you in one direction. You can find other information that points you in another direction. Those of you who follow FinTwit regularly, that is a very common occurrence, is people picking out particulars that might support one particular narrative or another. And what I'm going to try and do here, at least at the outset, is to really sort of bring it all together, because those comprehensive views, those comprehensive looks in terms of what's going on in the macroeconomy, I think are really useful in synthesizing where we are today and where we're likely to go. So the basic starting point, which in some ways is the simplest, is what's going on with the economy. And the short answer is the economy in aggregate is doing fine and has been doing fine for really a few years now. On the left-hand side here, what you see is U.S. real GDP growth, and what you see is a series of a number of quarters here where U.S. real GDP has printed pretty good outcomes, including the fourth quarter estimate, which, depending on exactly which measures you look at, what you see is something a bit above 2%. The most recent Atlanta Fed GDP now right around just between 2 and 2.5%. And what that means is we've basically had a period of at or above potential growth really for several quarters now. And it makes sense that in that context, what we see over here on the right-hand side is an unemployment rate that is both at secular lows and has basically been stable for 18 months in the 3.5% to 4% range. And so what does that overall picture look like? That's a picture of an economy that on a backward-looking basis is doing pretty well, growing enough in order to keep labor markets tight, and growing enough in order to keep unemployment low. Now, there are some consequences for that, and I think it's important to recognize what that strength in the economy is leading to, and in particular, how much strength is necessary, particularly when you think about job growth, in order to keep labor markets tight. The job market and the employment in the US is very different today than it was in the 2008 cycle and in the late 90s cycle. And the reason why that is the overall labor force growth in the economy is much, much lower today than it was in those previous cycles. So whereas, job gains, say payrolls numbers of 200 or 300 were really necessary to continue to tighten the labor markets back in those previous cycles, what we see today is it doesn't take much more than about 50 basis points of employment growth in order to keep the labor market tight. And that's what you see over here on the left-hand side, is comparing the job growth, which has slowed down, but is not that weak, all things considered, and particularly not that weak relative to the labor force growth. And there's lots of different ways that you can think about this, but the gist is that, if we see unemployment, if we see payrolls prints that are about 100,000 a month, that's 1.2 million jobs created a year. That's about 75 basis points of employment growth. Even that is enough to keep labor markets tight. And so there's a reason why we're seeing that unemployment rate the way that it is, staying at that low level, is that, with basically at potential growth, despite the fact that it might look like employment is softer than what you've seen in previous cycles. And that's because the rate that is necessary to keep the economy tight is so much lower. And the function of that, the consequence of that, of these tight labor markets, continues to be that wage growth remains elevated relative to where it was in the pre-COVID period. And so that's what you see over here on the right-hand side. This is the Atlanta Fed wage tracker. It's a particularly useful tracker because what it does is it lops off the very rich people who have high propensity to save incremental income, and it matches between one job holder. It matches job holders through time to ensure that you're getting a good picture of actual individuals and their wage growth. And what you see here is really it's stabilized right around between 5 and 5.5%. This chart is actually not updated for the data that was released late yesterday, which showed a small uptick in this number on the monthly year-over-year numbers. And so all of that pointing to the fact that we have wage growth that's elevated, and I think important to contextualize it relative to the pre-COVID wage growth that was going on, which was running kind of 3 to 4 along this measure, whereas today we're running sort of 5 to 5.5. And that pickup in wage growth is reflection of the combination of the fact that we had an inflationary impulse. And so real wages are catching up. People are negotiating higher wages given the higher level of prices in the economy. And it also reflects the fact that that the labor market is very tight. And so while it's it's gone from what I like to say is scorching hot in 2022 to something that's a bit more just secularly tight. It's tight enough to keep pressure on wages to continue to grow. We've had, again, just to take a step back and make sure we don't get lost in all the particulars of these different dynamics. So strong, at potential or a bit better growth, unemployment and labor conditions secularly tight, getting wage growth that's elevated relative to the most recent cycle, and inflation, which has moderated to some extent, but is highly reliant on a number of large disinflationary pressures to continue to print at a pace that's close to the Fed's target. Now, if you go out and read a lot of commentary, there's a lot of folks who are highlighting that inflation is now back at the Fed's mandate, and therefore the cuts will come. And I'd emphasize that both the reader and also the Fed will be careful about necessarily being certain that we've entered a totally different inflation regime than we had over the course of the last couple of years. And the reason why that is that inflation has moderated considerably due to an unwinding of many of the supply chain pressures that had caused its pop over time. What that means is as the prices have gone from rising rapidly to flattening to falling, that's created a disinflationary impulse into the aggregate price increases in the economy. In order for that disinflationary impulse to persist, which is necessary in order for inflation to remain at about 2%, those price falls would have to continue at the same pace. And so if you look at sort of two representative examples, which is highlighted by the breakdown on the right-hand side, a big part of why we've seen on the headline numbers a moderation of inflation is a function of a relatively rapid decline in gasoline prices. If you look, if you go back last summer or 2 summers ago, gas was at 5, it fell to 3.5, popped up to 4, and really in the last 10 weeks, it's gone from 4 to $3 a gallon on a blended average basis. That is a big disinflationary impulse, which is helping bring down inflation directly in terms of how it's measured, but in other places as it passes through. But in order for that pressure to persist, that disinflationary impulse to persist, what you have to have is you have to have gas prices keep falling at that same rate. Well, $1 a gallon, every 10 weeks is not going to persist for forever by any stretch. And we've started to see some stabilization. So that disinflationary impulse is behind us, not ahead of us. Similarly, we've seen a big shift, particularly in durable goods prices, which had risen considerably as a function of supply chain shocks. That has shifted over the course of the last year, where those price rises that emerged during the post-COVID period have now started to decline. That decline has led to negative price growth in those particular products. Think of things like used autos. And what we're now at, and what you can see in this blue line here, is that we're now at a level of deflation or deflation in these products that is equivalent to the significant deflation that we saw during the globalization and China manufacturing period in the 2000s. Now, will that persist? In order for inflation to remain again at 2%, which is where it's been recently, that rate of deflation would have to persist well into the future. And I think there's good reasons to believe that that level of deflation might not be persistent, both on a short-term basis, as we've seen some supply chain issues emerge. The New York Fed's measure of supply chain pressures went from meaningfully contracting, meaning getting a lot better fast, sort of neutral. And so that gives you a good sense of the aggregate dynamics across a lot of different products. And of course, we've seen emerging issues related to supply chains that have come on as a function of the geopolitical tensions in the Middle East, which have caused an extension of shipping costs, it's shipping times and shipping costs, both of which are meaningfully inflationary, particularly on this area, which is durable goods and goods, that has been so critically important to creating that move down in headline inflation and core inflation to roughly the Fed's mandate. And so what's offsetting that is this underlying structural dynamic, which connects to the labor markets and to the challenges, the tightness in housing, which is, housing costs and housing related costs continue to rise. A big reason why that is that despite the fact that new asking rents have moderated their growth rate from being elevated to close to zero, the vast majority of tenants are rolling their rental costs, which are still elevated, contractually agreed upon, and still elevated relative to zero. And housing costs are definitely rising as house prices have now returned to rising between 0.5 and 1% a month. And so you've got that part of the story where we're not quite getting the moderation in housing costs that you might have hoped for or might think is occurring if you just look at those asking rents. And then, of course, underlying this is also traditional services that are driven by employment and wage growth. And that area that the Fed has highlighted regularly, which is that core services X housing, continues to print numbers that should be disconcerting for the Fed in the 5 to 6% range. That's in line with wage growth. And most importantly, has actually shown some acceleration in the most recent period. And so if you get a situation where you no longer get that disinflationary impulse from oil prices, and no longer get that disinflationary impulse from goods prices, particularly durable goods prices, and you still have those underlying structural inflationary pressures that exist from a tight labor market and elevated wage growth and housing costs, you could easily have a circumstance where what happens is inflation moves from where it is right now, which is, looks for a moment like it's consistent with the Fed's target, to have that moderate up over the course of the year to something between 3 and 4%, which would be a significant concern for the Fed and well outside of making the case that inflation has moderated to their target. So in that context, just again, if you take a step back, secularly low unemployment, so a very tight economy, you've got growth that's doing pretty well. Almost all this data is that we're seeing right now, the vast majority of it is through November, not really totally through December. And you've got inflation, which has come down, but it's not quite durably at the Fed's mandate. And what we've had over the course of the last 10 weeks is one of the greatest easing of financial conditions in 40 years. typically the magnitude of easing of financial conditions that we've seen in the last 10 weeks would have aligned with periods of time where we bottomed, where we experienced cyclical bottoms, and they were typically created by central bank easing. So the magnitude of easing that we've seen in the last 10 weeks of financial conditions, we've seen has actually been larger than what we saw in March 2009, the bottoming of the stock market post-global financial crisis, and back in the 2002-2003 period, where we had a bottoming of the US equity market following the tech crash. Those are the times that we've seen this type of easing. What we're seeing today is a very different story, which is a huge easing that's occurring in the context of an already tight labor market and an economy that's already operating at capacity. And that's a very important dynamic, very different dynamic than some of those previous cases. And so what we see here is significant stimulation. Stocks are back near highs. Credit spreads are basically, at the between 10 and 20th percentile of all-time tights. You see yields have basically fully reversed 120 basis points. And so have fully reversed where they were, the up move that they saw last year. And gas prices, which are a disinflationary impulse, but they're also a positive growth impulse because that savings at the pump can go directly to additional spending, particularly for high propensity spending cohorts, lower income, high propensity spending cohorts. That's essentially like a stimulus check for many of them, the lower gas prices. And so you add this all up, this is a significant easing of financial conditions in the context of an economy that is already strong and secularly tight. And what we're seeing in response to that significant easing is if you squint at the most timely data, which is important to do to try and see whether we're actually getting a responsiveness to this change in conditions. I think what you see here is you're starting to see various corners of the economy start to pick up. If you look over in the housing market, we've seen a significant decline from in the eights, mortgage rates in the eights to in the lower sixes. That's been an important stimulative effect for the housing market. We've seen some improvement in sentiment there. And we've also seen a pickup in mortgage applications in line with that. And when I say a pickup, what I mean is mortgage applications had been slowing considerably relative to hotter periods. But what's actually happening there is we're seeing a slower rate of contraction. And for instance, the mortgage applications that were printed earlier this week looked on par with 2016, basically the same time of the year in 2016, whereas they had tracked considerably below those 2016 measures in previous over the course of 2023. And so that slowing of the contraction is a positive growth impulse, is showing that the economy is responding to the lower mortgage rates. We're also, if you squint at the employment data, and of course, many of you know a lot about many of you read my weekly tweets about the fact that the U.S. Labor market is secularly tight. I think if you squint at that data, I think it actually suggests the possibility that we're seeing an improving set of conditions in the labor market over the last 8 to 10 weeks. You see continuing claims relative to similar dates in recent years starting to moderate. And you're seeing initial claims which have come down a fair amount and are basically at the lows of the last 2 years. All of that points to the fact that we are starting to get some reacceleration of the economy in response to this easing, and that comes from a base that was already growing at above potential. Turning our attention to then what's priced in the market. So that's the story in the economy. You add that all up, and what I'd say is there's a pretty good possibility right now that at least in the first half of 2024, we're going to have a pretty good economy, pretty decent. And that is through the combination of the underlying momentum, the wage growth, the stronger asset prices, supporting financial conditions, supporting activity, and continuing the path here of elevated growth at a time when unemployment remains relatively low. We don't see any indication that there's been a meaningful deterioration in employment conditions. And so you put that together, that's a pretty good growth outlook for the first half of 2024. And then you turn around and look at the market pricing, and what you see is a shift to significant cuts being priced in to the short rate market. And on the left-hand side, what you see is the distribution of different outcomes at different periods. So by June, the modal expectation is for somewhere between 2 or 3 cuts, and then by the end of December 2024, you have a pricing which suggests greater than 25% probability of interest rates below 3%. Actually, it's about a 35% probability that there'll be at least 200 basis points of cuts or more. Those are all aligned. I think what I'd say when you look at that is that is pretty terrible economic conditions that are priced in to those rate markets. Now, folks will point out the fact that the moderation of inflation, and the Fed has talked a fair amount about thinking about real rates as a way to think about the tightness of monetary policy. And they'll highlight that because we're seeing moderating inflation, the Fed may choose to cut interest rates as a result in order to keep the real rate neutral. And there was some indication of that through some various governors' comments, as well as in the press conference in the last couple meetings. But what I'd highlight, and many folks point to the SEP as an indication of their intention to cut, with 3 cuts noted or expected on the median dot in the SEP by the December 2024. But I think it's really important to recognize what is in that SEP is not just the planned monetary policy actions, but a set of economic conditions that connect with those monetary policy actions. And what that suggests is that the unemployment rate, those cuts will come at a time when we see a meaningful weakening of the unemployment rate to the low 4s, to 4.1%. So it's not 3 cuts if growth continues to strengthen and continues to be strong. If unemployment remains stable or even falls, that's not how you're going to get 3 cuts. You're going to get 3 cuts if there's a meaningful deterioration in economic conditions. And so that's an important interplay. When you look at what's going on with economic conditions, you see there's not a lot of indication that there will be a meaningful softening in the short term. If anything, what the indications are for a bit of acceleration here in the first part of the year. And at the same time, a lot of cuts are priced in. Adding further pressure to this, we've seen the CPI report this morning as we tape this, another core print that was in the 0.31 range, which is, implies an annual core inflation rate measured by CPI between 3 and 4%. It's certainly going to be challenging for the Fed to institute a rapid easing program, either consistent with what they measure in the SEP or what they say in the SEP, and certainly inconsistent with the extreme cuts that are priced in to the short rate market, in an environment where inflation remains a bit above what their target is, and parts of that inflation look pretty sticky, and the economy is doing pretty well. And that's really the challenge that I see here in terms of the pricing, which is we basically have a huge gap in expectations that has emerged over the course of the last couple of months, where the macroeconomic conditions would suggest roughly stable monetary policy, at least for the next 6 to 9 months. The Fed is suggesting that economic conditions may weaken, which will cause them to cut interest rates 3 times over the course of 24. And at its most extreme, the financial markets, the short rate markets, were pricing in between 6 and 7 cuts over the same time frame. So there's a big inconsistency between those 2 points. And in particular, it is driven by this right tail that you see here on the left-hand chart, which is a very high probability expectation of a lot of cuts coming into the market, likely due to the fact that there's going to be expectations of very weak economic conditions. And that's what seems like a low probability event. Like I wrote today on my Twitter feed, the probability that that the economy remains fine and that the Fed does little to nothing over the course of 2024, that probability is baked in at about 10% in terms of the options markets on December 24 short rates, about a 10% probability of that. Whereas the probability that we have a significant recession is priced between 30 and 40%. My guess is that the reality of those probabilities is flipped given the macroeconomic circumstances, that the possibility that we have good enough growth and a modest increase in inflation that's sufficient to cause the Fed to be a little more hesitant to cut, I'd say is in the 30 to 40% range. And the odds that we have a meaningful recession consistent with what's priced in here in terms of hundreds of basis points of cuts in 2024 is probably closer to 10%. And so the probabilities of the pricing look flipped relative to the probabilities of the macroeconomic realities. We're also seeing a circumstance where on the long end, we're seeing a weakening of growth getting priced in as well. You can often look at stocks relative to bonds to get a good understanding of what's expected for economic growth conditions. And I think one of the things that's been very interesting since the significant policy changes that occurred in early November is that the bond market has rallied relative to the stock market, on a risk-matched basis. And so that's important to think about because we've essentially had the greatest financial easing in 40 years over the course of that 10 weeks. And yet the intermarket action is such that it's implying that stocks are going to that forward-looking growth conditions are likely to be worse than before that easing, not better. That's what you see here with bonds outperforming stocks or stocks underperforming bonds. The types of conditions that we're seeing today with that easing and the strong growth and the pricing that's currently in the market should typically lead to stocks outperforming bonds. Just think about it. What happened in March 2009? What happened in the spring of 2003? What happened in those circumstances when we had these huge financial easings, these financial market easings, is that stocks subsequently meaningfully outperformed bonds as the economy accelerated. And so that's the dynamic that I would expect to see. Similarly, what we're seeing over here in the internals of the equity market, we did see some compression in the least loved areas of the market, particularly the small caps relative to the large caps. And these small caps are the most sensitive to this pickup in liquidity conditions. But I note that after a reasonable part of the driving of that was a number of hedge funds which experienced a short squeeze as there was some sector rotation and size rotation, that since the start of the year has actually moderated considerably. And so if you compare where we are today on the Russell 2K versus S&P 500 versus where we were before this easing started, only 3% of the nearly 15% gap in return in 2023 has closed between those two through the beginning of this year. That really creates an opportunity. Typically, you should see small caps and the most liquidity sensitive stocks in the economy improve as a function of the significant easing of financial conditions. And odds are, as that increasingly gets recognized, we'll be seeing a factor rotation that, again, is towards stocks in aggregate relative to bonds, and also towards the riskiest part of the equity market and away from those segments of the market that were the primary drivers of outperformance in 2023. Overall, I want to contextualize this because I think we can get sucked into the particulars of the market pricing and the economic conditions today, and can lose sight of essentially the way in which the market is operating. And that has shifted considerably over the course of the last couple of years. For a long time, particularly post GFC, the way to make money in the market was to get quickly on the turn or the trend, identify those quickly and get in, and then take a lot of risk when you had that opportunity. And so that made a lot of sense when, in particular, when Fed liquidity conditions were the primary driver, shifts in Fed liquidity conditions were the primary drivers of what was going on with financial market performance. But what's going on today is very different. In many ways, the Fed is not particularly influential in what's happening. And what's happening instead is that the macroeconomy is very, very, very slowly moving, as it typically does. And what's happening is that expectations of what's likely to transpire in the macroeconomy are whipping around hugely relative to the reality. If you go to that first chart, and I just showed you that, and I said, what do you think is going on with this economy? An economy that's seen, 6, 7, 8 quarters of roughly at potential growth, you'd say like not much, seems pretty boring. But trading markets, and particularly trading short rates, has been anything but boring over the course of the last couple of years. And the reason why that is from these huge moves in expectations, outsized moves in expectations from folks who are trying to identify the turn when the reality is there is no turn. The economy is just meandering along like it typically does. And so I like to look at this chart and just sort of think about all the different stages that we've seen over the course of the last sort of 15 months, from immediate recession to start 23, to higher for longer, to a credit crisis, to the productivity miracle, of course, to even higher for longer, to the Treasury easing, and now to the expectation that recession is coming and deflation is upon us. Those are huge, wild swings in the markets that haven't equated to the changes that are going on in the real economy. And I think particularly entering this year, and a bit of this is closed over the course of the last couple of weeks, but we still have a ways to go. We're seeing another one of those extreme market pricing instances where expectations are relatively extreme compared to the reality, and where in all of these circumstances, your best bet was to fade the extreme pricing. And we're seeing another one of those circumstances again today. That basically sums it up for the US. I'm going to do a quick run through of what's going on in the rest of the world, because I think there's some interesting observations before I get to the audience questions. I think in many ways, Europe is the exact opposite of the US in the sense of inflation has moderated considerably. That's what you see in this upper right chart. That moderation of inflation has now brought core and headline inflation basically between 1% and 2%, which is where the ECB's mandate is, their sole mandate. We've seen a significant slowing of economic conditions, where we've seen probably 6 months of negative GDP growth. If you take a bottoms-up perspective from the underlying data and don't wait for the actual GDP report, that's what it's looking like here in the second half of the year. And yet the amount of easing that's priced in to the European curve is the same exact amount of easing that's priced into the US curve. Now, think about that. You've got two economies that have radically different outcomes. One, which has secularly tight conditions, inflation that is still a bit above what the central bank's mandate is, and growth that's above potential, and it just experienced a huge easing. And you've got another economy where inflation is below the central bank's target and where growth is contracting. Two totally different environments, and yet the same pricing. And I think that creates a very interesting opportunity from a diff perspective. The UK is another example of this as well, pricing in basically the same amount of cuts as in the US and as in Europe. I think it falls nicely in between the two, where growth conditions are weaker, but there's still inflationary pressures. And so you have a central bank that in many ways is not even thinking about easing, if you look at what their most recent votes are. And so I think it's another case where the idea that the Bank of England is going to cut anywhere near as much as the ECB over the course of 2024 seems improbable given the set of conditions that are in the UK relative to the set of conditions that are in the Eurozone. Japan, totally different story here. We talked basically 9 months ago, for those of you who follow me on Twitter, about the shift in central bank leadership and whether that would create a significant change in monetary policy. Since then, the Bank of Japan has done a couple of tweaks of their yield curve control measures, but has not significantly shifted their policy stance, which is one that is incredibly easy over time. And if anything, that is increasingly making sense for them to not shift any further, as what we see is that the inflation measures have come down considerably. Over there on the left-hand side is the core inflation, which is printed, in the 1% to 2% range over the course of the last couple of months. We saw the same with the Tokyo CPI number that came out earlier this week, as well as the wage growth numbers, which were printing at 0 year over year. None of that from an inflation perspective suggests an inflation problem or an urgency to tighten. And at the same time, we've seen some moderation in growth, particularly driven by some of the weaker demand circumstances in Asia. And so that's what you see over there on the right-hand side is negative GDP growth, low inflation. This is not an economy where it makes sense to tighten anything. Yet 65 basis points of tightening are priced in to the short end in Japan in 2024. The odds that happen, given the set of conditions, seem very low. And finally, I'll end with China, which, as the world's second largest economy, doesn't probably get talked about nearly enough relative to its global macroeconomic importance. And so we at least have to touch on what's going on with it to understand it from a global macro perspective, even if the individual markets aren't necessarily what you're trading on a day-to-day basis. And I think the thing that's really interesting about what we see in China is experiencing a deflationary slump. And that deflationary slump is something that, plenty of economies have experienced through time. The solution to a deflationary slump is relatively straightforward, which is significant monetary and fiscal easing in order to re-stimulate the economy. And nonetheless, what you've seen is that policymakers, and particularly the PBOC, but also the central government, have chosen not to engage in that stimulation. And so what you see here is a very classic set of intermarket action, which I think is very interesting, which is stocks are falling and basically have been at their lows of the last 15 years, basically at 15-year, at the same price level as they were 15 years ago. Bond yields are falling to the lowest level that they've seen in 15 years. All of that is deflationary slump dynamics. And yet, in an economy where the debt is in their local currency, they have a fair amount of flexibility from a government perspective to stimulate fiscally. They have a fair amount of ability to stimulate on a monetary basis. And so they're just not doing it. It's not a matter, their conditions are not a matter of circumstance. They're a matter of choice. And I think if you go under the hood and look at some of the dynamics that are going on, there's really been a political centralization, in particular on the monetary side of the PBOC, historically, which had been driven by technocrats, Western educated technocrats who were implementing monetary policy in a way that was maybe not exactly consistent with, but informed by historical Western monetary policy approaches and tactics. Nearly all those people have been removed from the PBOC, quit, or been shuffled out, and instead political appointees have been put in place. And so what we're seeing here is, and there's a good FT article about that, which I sent out earlier this week. And so what we're seeing here is a set of choices to run a weaker economy. I won't opine on the exact reasons why. That's above my pay grade in terms of the geopolitical decisions that are going on there. But certainly from a perspective of a macroeconomy view, what we're seeing is really a real prioritization of the exchange rate relative to domestic growth circumstances. Part of that's driven by the fact that there's been such a significant pullback in capital in China that there's an underlying weak set of conditions for the exchange rate. And part of it is driven by focus that exchange rate stability appears to be a primary goal above domestic stimulation. And the reason why that is typically what you do in this circumstance is you'd ease. That easing would lower your currency, which would be stimulative, and support your stock market, and they're choosing not to do that. And if anything, you can even see their policy is highly responsive to exactly what's going on with the exchange rate. So they provide a little bit more liquidity when the exchange rate stabilizes, and they highly tighten liquidity domestically when the exchange rate is facing downward pressure. And so China in many ways looks like an economy that is stuck. And a lot of those hopes that I think had been dashed several times over in 2023. I think it's starting, it's time to recognize that from a global macroeconomic standpoint, probably not worth expecting that China is going to experience a significant acceleration in any way. That may change. We'll keep an eye on the markets, particularly the stock and bond market dynamics, but unlikely to change in the future. That pretty much wraps up the outlook. We'll hit a couple of audience questions here. The outlook took a little bit longer than I was expecting, so we'll try to get to as many questions as I can. I'll go a little over the top of the hour, and appreciate anyone who wants to stick around. Let's get to some of these questions that came in before, and then for folks who have questions that have come up, chuck them into that Q&A. I'll try to manage this live. There's a number of questions we received that had to do with the QRA and the expected QRA policy. QRA, for those who are unfamiliar, is the quarterly refunding announcement made by the Treasury. And what that means is basically is the quarterly policy in which the Treasury announces how much it's going to borrow and the profile of that borrowing. In the past, this was not very interesting since deficits were known, and the profile of the debt was primarily driven by technocrats who defined exactly what they wanted to do. There's a set of rules in terms of what that debt mix should look like. That changed really significantly on November 1st when Janet Yellen went out, who's the Secretary of the Treasury, went outside those expectations and meaningfully cut back the amount of duration issuance relative to expectations, which was in part a driver of the rebound in asset markets that we saw in November and December. I think I'd emphasize that what she chooses to do for her next policy announcement in terms of how to finance the extremely large deficits that the U.S. is experiencing is unknown. It is extraordinarily uncertain, and I'd say this is probably the point in time, the biggest point in time in my career where we've seen a real ambiguity about what the policy the policy decisions and the reaction function is from such a critical influence on the asset markets. The reason why that is Janet Yellen has an incredible amount of flexibility in terms of what she could do. The size of the debt profile, the size of the debt means that issuance in any one quarter or couple of quarters doesn't make any difference in terms of the overall debt profile. She could go to 100% bills or increase her coupon issuance, and it largely wouldn't make a difference in terms of the overall debt profile in the short term. So it's up to her, and it's up to a person sitting in a political circumstance, a political position, to make this decision. What will she do is very hard to know and very uncertain. I think there's reasonable cases to be made that she'll be swayed by the technocrats, and reasonable reasons to believe that she'll use it as a tool of political influence to try and stimulate the economy. But I think for most people, what's better to do than speculate on a leading basis is to get the report, read it, understand well what the implications are, and position for it. And for those folks who did that in the November 1st meeting, there was something like 8 weeks of rally in stocks and bonds that you could take, that you could have if you had positioned at 8:30 in the morning on November 1st. So I think that's probably the best thing to do rather than to speculate on what's likely. A couple of questions here about the balance sheet, in particular, why they are suggesting that they're going to taper quantitative tightening prematurely, and whether the liquidity trends in the RRP facility are important to think about. As a reminder, when the Fed can take in deposits either from the government, which is the TGA, from bank reserves, or they offer the RRP interest rate as well. And what we've been seeing is the RRP has been drawing down. The overall balance sheet, of course, has been contracting as a function of quantitative tightening. Bank reserves have been picking up. The TGA has been picking up over the course of the last couple of months, and the RRP has come down considerably. I think the Fed is concerned about the fact that their overall balance sheet will contract, and that will in particular reduce the amount of bank reserves, which is a cash asset for the banks and helps provide a liquidity buffer for the banks. And so I think they're particularly concerned about seeing a circumstance where bank reserves start to fall meaningfully. They'd rather have, from a financial stability perspective, the banks remain liquid and have the cash levels that they currently have. And so in the last week, they've discussed, I should say, not necessarily announced, but discussed, as well as in the Fed minutes, a tapering in the pace of quantitative tightening in order to ensure that the RRP doesn't go down to zero and to ensure that those bank reserves remain plentiful. That wouldn't necessarily be the policy I'd choose. I think banks have more than enough cash, and cash isn't a meaningful influence on banks' financial stability or their activities. But there's reasonable financial stability reasoning why you might not want to chance it. And so this idea that the Fed is going to taper the pace of quantitative tightening, they might lengthen it out and kind of slow it down, so that's kind of fading into the background, is a reasonable policy choice. On the margin, that's supportive to asset prices as you go from a player in the market who's selling assets to selling assets at a less rapid pace. Is that going to be a meaningful influence? Probably not. And the reason why that is the volatility of debt issuance from the Treasury far outweighs the volatility or the influence of quantitative tightening. And so therefore, the real thing that matters is what Janet Yellen chooses to do in terms of the debt profile of the U.S. rather than the precise path of quantitative tightening in the U.S. Basically, does the Euro USD pricing make sense in the context of the relative economic conditions? And I think it's a very good question. It's one in which, when you see in the short rate mark, when you see a big divergence in macroeconomic conditions, and you see, which would imply different directions of monetary policy, and you see a set of pricing in the short rate market that is consistent between those two economies, that could easily lead to pressure on the exchange rate on a forward-looking basis, with Europe being considerably weaker and likely needing much easier monetary policy than the U.S. At its core, what that speaks to is the fact that, and I'll probably wrap it up here, the U.S. is outperforming. The U.S. is on a path to outperform the rest of the world over the course of at least the first half of 2024. That has important, yet it is being priced to be weak. And as that pricing comes out, particularly in the bond market and the short rate market and in the exchange rate market, we're likely to see significant shifts that occur as that pricing comes out, whether it's on the short end, whether it's on the long end, or whether it's through the dollar. And so that whole complex of things is very bearish for the dollar, very bearish for rates and bonds, bullish for the dollar. And for stocks, you see a cross-cutting set of circumstances here because the strength of the economy is likely to be even stronger than what's expected and likely to deliver, a bit better earnings outcomes than may be implied from a bottoms-up perspective. But that rise in rates is going to be challenging in terms of valuations for stocks if we get it. And so that balance, the way I think about that balance is trade the thing that you think is the best reflection of what's going on. And that's stocks versus bonds, which reflect what's going on with overall growth. And so probably more than anything, when I think about the equity market, it's setting up for a set of conditions that are particularly bullish stocks relative to bonds over the course of the first half. We'll wrap it up there. I've gone almost 15 minutes over. I could talk about this stuff all day. Thank you so much for taking the time, a few minutes out of your day, to join us for our monthly macro webinar.